Hello guys, hope all of you are doing good, and even me too, I'm doing good. So today our interest is to look how to start our meeting with looking at the subject at hand, financial modeling and forecasting and all that it entails. But for today we will just be looking at the course outline for financial modeling and forecasting and something to do with introduction to financial modeling and forecasting. We'll be looking at these terms: financial, then what is meant by modeling, and what is meant by forecasting. So to start with sharing the screen, I'll just come there, then start with this financial modeling and forecasting, and here we are. So financial modeling and forecasting is a prerequisite unit, and most of the time it is a unit that is being used in finance. If you are a finance student, you have to go through financial modeling and forecasting. It is a core unit in finance, and other units like advanced taxation is there. We have like financial institution and management. So for our interest, this is our subject at hand today. So this trimester, everyone knows, then the credit hour for this unit is 3 hours. Lecturer name you can see, tell contact, that is how you can reach me. Then the core unit, the code is FM202F or FIN2303. Course title: Financial Modeling and Forecasting. Then prerequisite to financial planning and control. Then what is the purpose of this subject at hand? So the main purpose for this subject is that it just introduces the tool to utilize in financial modeling and forecasting, and most of the time it's applications of different approaches in financial modeling and forecasting. How will we look at something to do with regression analysis in financial modeling? Then the expected outcomes for this lesson is here. So the expected outcome, you find that at the end of this lesson you have to build blocks of financial forecasting, identify vertical and horizontal relationship among financial parameters, then use computer packages in financial forecasting. What does it mean for you to use computer packages? This is a scenario where you do your financial modeling, like regression analysis. How can you do two multiple regression or two regression analysis? We have always three, those something like the multiple choice, all that applies in the regression analysis. Then you find that the course outline is here, and this is what we have to start looking at. So then we have topics of subject. So week 1 we are supposed to be doing introduction to financial modeling and forecasting, the definition, type of forecast and step of forecasting process. Then week 2 to week 5, modeling and forecasting techniques like accounting analysis approach. Then we have industrial engineering approach, high-low method, regression analysis. We have simple and multiple regression analysis. Then we have correlation analysis, Pearson and Pearson rank correlation. Then we have goodness of fit. Then we will be doing our comprehensive cutting week 6. So to begin with our topic 1 in financial modeling and forecasting, let's look at what is it that is entailed in financial modeling and forecasting as it is concerned. So you find that a bit of introduction to financial modeling and forecasting is that how do we do modeling and what are some of the critical terms or the crucial terms that are used in financial modeling and forecasting. So we found that a model is just a method used in to explanation a relationship that exists between a set of variables where you have fixed variable, you have variables itself, and all that other independent variable and dependent variable. So we found that here we will be just looking relationship between two variables, and you can see we have independent, explanatory, that variable, all of it. So what does it mean by the term forecasting as used in financial modeling and modeling? So forecasting is just prediction of the future, how variables are expected or predicted in the cost, either in future or at any given point, how two variables relate. So forecasting in simple terms is the prediction of future value of variables, e.g. predicting the expected cost of in future. So financial modeling and forecasting in general, here we are. Financial modeling and forecasting is concerned with method used to predict the uncertain future in an effort to help managers and even other business just to make informed decision or better decision. And this effort always involve the study of historical data. And if that is not enough, it also involves manipulation of this data to search for pattern that can be effectively extended into the future. So that is some or just some of the definition of financial modeling and forecasting. But there are several definitions of forecasting. The key terms here, it is just a method used to predict uncertain. This is the key term, uncertain future in an effort to help managers, and not even just managers, other financial related experts, even a finance students. This course will automatically help you to make some uncertain decision or just informed decision in financial environment. So what are some of the classification of forecast? So we always have short term, those ones that took a long period of time, in a short period of time, and we have long term forecast which took long term period or long period of time. So short term forecast, these forecasts are used to design immediate, from the word short term, immediate and mid-term strategy of an organization. They are thus used by the first line and middle level management to meet some mid-term needs of an organization. And how does that happen? In an organization, we have hierarchies. Either we have high level, middle level, and we have low level management. So in high level management is where we always have the managers. Middle level we have the supervisor, and this low level we always have the casual employees. So at the short term it is always for immediate. Then long term are always necessary to set general course of an organization in a long term, just as it is defined by its own term. They thus become particular focus for top managers. So always all decisions made by top level management are always long-term focus. And if that is not enough, there is always micro and macro focused. And what does this entail? You find that this will depend on the extent to which a particular focus either involves more details or highly summarized value, e.g. a plant manager. How does a plant manager do this? You will find that a plant manager may wish to forecast the total number of employees to be employed in the next financial year. How many employees should we be getting into our organization? So that is what is entailed with macro and micro forecast. And if all that is not enough, you will find that this is where the government may wish to forecast the number of people to be absorbed in the entire workforce, in the entire economy, whether it is public, private, informal sector, in the next year financial budget, like just the budget which was read. These are some of the plans that the government should put in place to make sure that how many more employees should be absorbed in a year, which organization will absorb them, and those are some of the questions at hand. So if that is not enough, we have to look about quantitative and qualitative forecast, and these are some of the forecasting methods that you are using, financial modeling method. So you find quantitative forecasts are just those that need no input of judgment. They are always mechanical procedures that involve manipulation of data and producing or to produce quantitative result. We always have qualitative forecast. And what does qualitative forecast deal with? You find that these are just those acquiring no manipulation of data and only judgment of the forecaster is required. Like this quantitative forecast it is just all about mathematics. Things like regression analysis are just all here because you have to quantify between the independent variable and the dependent variable as forecasting is concerned. That is that. And let's continue with the forecasting step. What are some of the steps of forecasting? So some of the steps of forecasting here are as follows. All forecasting procedures involve number one, and this should not be exchanged in whichever way because these are steps. Like just having a step to prepare tea, you have a procedure for preparing tea. You can't change any of the procedures. So number one, extending the experience of the past into the uncertain future, and thus involve the assumption that the conditions that to generate past data are indistinguishable from the condition of the future, except for those values explicitly recognized by the forecast model. That is one step. The second step is the recognition that forecasting techniques operate on data generated by historical events. Historical events are just simply the past events that can be used in forecasting. So, with all these types of forecasting, that will lead us to identify the following steps in forecasting. These are just procedures, all procedures. They are the two, but for the real steps are here. So number one step for forecasting is data collection, and here you have to know what does data mean. And in just a simple word, data are just raw facts and figures that has no meaning. So how do we collect data? You just go to the field and collect data. This is one of the steps of forecasting. So you find that this involves gathering of raw facts from the field using methods such as observation, use of questionnaires, interviews, literature review, etc. This is often the most challenging step since the subsequent step can be performed whether the data collected is relevant to the problem at hand. So if you doesn't collect data wisely, it will automatically affect the second step of forecasting. So second step of forecasting, which is data reduction. So these are just some of the data items that may be relevant to the problem at hand and thus may reduce forecasting accuracy. and you find that such data do not included or are not or will not or should not be included in the development of the model. So with data reduction, you will automatically go to modeling building. How do you build your model after data reduction? You have data, then you sieve that your data. You just pick the important information that is containing the data. So data building involves fitting the collected data into the forecasting model that is appropriate in terms of minimizing errors in forecasting, and all that is simpler, or it is the simpler, or the simpler the model, the better it is in the term of gaining acceptance of forecasting process. So if your data is simple to understand and it contains some of the goals that are needed to attain the forecasting, it will be better for it to be accepted by the person who is concerned by collecting the model. And number 4, we have model extrapolation or just actual forecast. After you gathering your data, then you are doing that reduction, then you are building a model from the existing data. The next step is how do you now do your actual forecast, and this just involves the actual model forecast that are generated once the appropriate data has been collected, and that is always possibly reduced and appropriate forecast model is chosen. And after you just doing your actual data, you will just come to forecast evaluation. This is now where you do your evaluation based on data you put and you compare them with the other forecast values. And most of the time, as I told you, you can compare here with your data with the historical value, and the process also may just be most relevant values often held back for the data. So you will find that in this forecast evaluation, it involves comparing forecast values with actual historical values, and in that way, in this process, a few of the most recent values are often held back from the data back set, and it is always used to generate the model. Once the forecast model is complete or it is completed, the forecast is done. And what next will follow? We find that they are compared to the actual historical value to see if it makes a lot of sense, and that is what determines forecast evaluation. So that is what is there to do with our chapter 1 of financial modeling and forecasting. That is the most important thing to be doing in financial modeling and forecasting, and that is what is required in financial modeling and introduction. So we'll just be coming here looking at introduction to financial modeling. You will know that what is a model, then you just see there is a method that is used to explain the relationship that exists between a set of variables. And here we always have independent variable, dependent variable. So in a scenario where you have your equation y is equal to a plus bx, so here you have two variables. We have independent variable in the equation and the dependent variable in the equation. Y is always dependent variable, and it is always very important to know that. And x, which is always on your right hand side after the equal sign, is always the independent variable, and you're supposed to be knowing how they relate. Then you come forecasting. What does it mean? It's just prediction of future values, as simple as that. Then in general term, if you are asked what is financial modeling and forecasting, then you can just say that it is just like a branch of finance that is concerned with predicting some uncertain future. events that you can help any finance manager or any business oriented person. And to that, you will be going just to classification of forecast, where you are supposed to be looking at short term, long term. We have qualitative, you have macro and micro forecast. After knowing that, you are supposed to be knowing what are some of the steps for forecast, where you by then you're supposed to be knowing that you're supposed to be doing data collection. Then after doing data collection, you're supposed to be doing that reduction. How do you reduce that data so that you can remain with the data that can make you have a very serious view in future? Then after that, you are supposed to be having your all your forecast at hand. After having that data collection, data reduction, then model binding or building, and some of the actual forecast, and finally forecast evaluation. You're supposed to be done with your introduction of financial modeling and forecasting. After that, you're supposed to be having, this is our topic 2, and of interest, it will be tackled most of the time. It will be tackled in our next class. We'll just do some of the introduction part, then in the calculation we'll do in our next class. So our topic 2 in financial modeling and forecasting is cost estimation. And what does this entail? You will find that while trying to carry out cost estimation, so there are some of these steps that are supposed to be followed. So number one step when you are doing cost estimation is you are supposed to choose estimation approach. And what are some of these approaches which are involved in estimation? Number one, we have industrial engineering approach. Then number 2, we have account analysis approach. Then you have visual fit approach. Then our regression analysis. We have learning curve approach. That is the first step you are supposed to follow when you are doing cost estimation. Second step after choosing the cost estimation approach is to choose the independent variable. How are the variables related between the independent and dependent variable? So you come to your second step, then choose the independent variable. And I told you independent variable is always the x variable, and the dependent variable is always the y variable. So we find that this is the controllable variable and is normally denoted by x, e.g. units of production, sales units, machine hour, and direct labor cost, etc. So after choosing your independent variable, you're supposed to come and choose the dependent variable. What does this dependent variable? In an equation of y is equal to a plus bx, y is always the dependent variable. It means that any change in x variable will automatically affect the y variable. So after choosing your, that is number 3, after choosing your dependent variable, and what does this mean? This is the cost of to be predicted, and is usually denoted by y. After that, after choosing your dependent variable, number 1, you are supposed to be choosing your cost estimation approach. Then you choose the independent variable, which is x. Then you are supposed to be choosing your dependent variable. Then the next step after choosing dependent variable, data collection. You collect data from both independent variable that you have chosen and the independent variable that you have chosen. So you have to choose data, or you have to collect data in both dependent and independent variable. Then you generate a model. How do you do this? After having or using the data value of both dependent variable and independent variable, you generate a requisite model for the forecast. Then after doing that, you evaluate the estimated cost function. How do you do that? You just ensure that the model developed and it is forecast actually makes sense. So if the forecast does not make sense, you know very well you have made a lot of